In 2024, a strange thing happened. A company called Enron announced it was back, with a slick website, a hype video, and a bizarre product called the Enron egg. It was a joke, a piece of satire. But the joke only works because of what the name Enron still means. The most spectacular corporate lie of its age. And the real story is far darker than any parody. This is the story of how a boring pipeline company became, on paper, one of the most valuable corporations on Earth, worth more than $60 billion, and then evaporated in weeks. But here is what almost every retelling gets wrong. Enron's fraud was not hidden in a locked vault. It was printed in the footnotes, signed off by auditors, and cheered on by Wall Street. The lie was in plain sight, and everyone chose to look away. It began in 1985 in Houston, Texas. Two dull natural gas pipeline companies merged into one, and a mild-mannered economist named Kenneth Lay became its chief executive. In those early days, Enron was exactly what it looked like: pipes in the ground, moving gas from one place to another. Reliable, profitable, and painfully boring. That was about to change completely. The change arrived in the form of a brilliant, ruthless consultant named Jeff Skilling. Skilling had a radical idea. Why own expensive pipes and power plants at all? Why not turn energy itself into something you could trade, like stocks or bonds? Enron would become a kind of bank, but instead of money, it would trade contracts for gas, electricity, and eventually almost anything. He called it the gas bank. To make this vision work, Skilling needed a special kind of accounting magic, and he got it. It's called mark-to-market. Normally, a company records profit when it actually earns the cash. But under mark-to-market, Enron could sign a 20-year energy contract and book all 20 years of projected profit immediately, today, as current income. In 1992, regulators approved it, and that approval lit the fuse. Think about how dangerous that is. Enron could report gigantic profits based on guesses about the future, profits that existed only as optimistic projections on a spreadsheet. No cash had actually arrived. And once you've booked 20 years of future profit today, how do you grow next year? You need an even bigger deal. And a year after, bigger still. Mark-to-market didn't just allow a lie. It required an ever-escalating one. Inside Enron, a culture formed to match the fantasy. Employees were ranked twice a year, and the bottom 10% were fired. A brutal system called rank and yank. It rewarded the aggressive, the confident, the ones who could close a deal and book a fortune before anyone checked whether it was real. They believed they were the smartest people in the room, and for a while, the whole world agreed. The rewards poured in. Fortune magazine named Enron America's most innovative company, not once, but for 6 years in a row. The stock climbed and climbed, past $50, past $70, toward $90. At its peak, Enron was worth around $70 billion, the seventh largest company in America. Executives were treated as visionaries, and the more everyone believed, the more the machine had to keep feeding itself. But underneath the soaring stock price, a terrible problem was growing. All those mark-to-market profits weren't turning into real cash. Enron was spending billions on failed projects, a broadband network, a water company, a power plant in India that lost fortunes. The gap between the glittering profits on the reports and the actual money in the bank was becoming a chasm, and that chasm had to be hidden. Enter the man who would build the machine to hide it. The chief financial officer, Andrew Fastow. Fastow's solution was elegant, complex, and deeply corrupt. He created a web of secret companies, partnerships with strange names like LJM, Chuco, and the Raptors. On paper, they were independent. In reality, Enron secretly controlled them, and their single purpose was to make Enron's problems disappear. Here is the trick, made simple. When Enron had a losing asset or a mountain of debt, it would sell it to one of these secret partnerships. Now, the loss was off Enron's books. It belonged to the partnership. The balance sheet looked clean, healthy, profitable, but it was a shell game. Enron was essentially hiding its garbage in its own back pocket and pretending the pocket belonged to someone else. But every one of these hidden structures had the same fatal flaw. To reassure the partnerships and the banks, Enron backed them with a guarantee. using its own soaring stock as collateral. As long as Enron's share price kept rising, the whole illusion held together. But it meant the entire hidden empire was balanced on a single point. The stock could never be allowed to fall. Not ever. And the corruption went deeper. Fasto didn't just run these partnerships to help Enron. He ran several of them personally and quietly paid himself tens of millions of dollars in the process. The man hiding the company's losses was also secretly robbing it. But the most disturbing part isn't Fasto's greed. It's that he didn't do it alone. He couldn't have, because everyone signed off. Enron's auditor, the legendary accounting firm Arthur Andersen, reviewed the books and blessed them, while collecting millions in fees. The biggest banks on Wall Street helped structure the deals. Stock analysts kept screaming buy, and Enron's own board of directors voted to waive the company's ethics rules so Fasto could run his partnerships. The watchdogs weren't asleep. They were being paid to look the other way. By the year 2000, Enron seemed unstoppable. It even helped engineer the California energy crisis, its traders manipulating power markets and joking on recorded calls about taking money from grandmothers as the lights went out across the state. The arrogance was total. They had convinced the world and themselves that the numbers were real. But 2001 was coming, and with it, the reckoning. In February 2001, Jeff Skilling finally became chief executive, his dream job. And then, just 6 months later, in August, he abruptly resigned, citing personal reasons, and sold large amounts of his stock. To the outside world, it was a shock. Inside Enron, it was a signal. The man who had built the machine was quietly stepping off the train moments before it left the tracks. That same month, an Enron vice president named Sharon Watkins did something rare. She wrote a memo to Kenneth Lay warning him, in her words, that she was incredibly nervous the company would implode in a wave of accounting scandals. She had seen the truth from the inside. The warning was clear, specific, and early, and it was ignored. On October 16, 2001, the mask finally slipped. Enron announced a shocking $618 million loss for a single quarter and revealed it was wiping out over $1 billion in shareholder value tied to Fasto's mysterious partnerships. For the first time, the outside world got a glimpse of the machinery hidden beneath the profits, and the regulators started asking questions. Now the fatal flaw did its work. As news of the losses spread, Enron's stock began to fall. But remember, the entire hidden empire was propped up by that stock. As the price dropped, the secret partnerships began to collapse, triggering more losses, which pushed the stock lower still, which collapsed more partnerships. It was a death spiral, engineered by their own cleverness and now completely out of control. As investigators closed in, Enron's auditor, Arthur Andersen, made a fateful choice. Employees began shredding documents and deleting emails related to the Enron account. Tons of paper fed into shredders over several days. It was an attempt to destroy the evidence. Instead, it destroyed Arthur Andersen itself, one of the largest and most respected accounting firms in the world, ending nearly 90 years of history. On December 2nd, 2001, it was over. Enron filed for bankruptcy. At the time, the largest corporate bankruptcy in American history, with more than $60 billion in assets vanishing. A company that Fortune had crowned the most innovative in America 6 years running had gone from a $90 stock to worthless in a little over a year. The seventh largest company in the country was simply gone. And now the true cost. Around 20,000 employees lost their jobs overnight. But far worse, many had their retirement savings locked in Enron stock, encouraged to load their pension accounts with company shares. As executives had quietly sold hundreds of millions in stock on the way up, ordinary workers watched their life savings fall to zero. Their loyalty was rewarded with ruin. Justice came, slowly and incompletely. Andrew Fasto cooperated with prosecutors and served around 6 years. Jeff Skilling was convicted and sentenced to more than 2 decades, later reduced. He walked free in 2019. And Kenneth Lay was found guilty on all counts, but died of a heart attack before he could be sentenced, his convictions legally erased by his death. The scandal did give birth to a major new law, Sarbanes-Oxley, meant to force honest accounting. So here is what most tellings of Enron miss, and it's the whole point. This was not a burglary in the dark. Mark-to-market accounting was approved by regulators. The partnerships were disclosed in dense and deliberately confusing footnotes. The auditors signed the reports. The analysts recommended the stock. Enron didn't sneak the fraud past the system. It walked the fraud through the front door, and the system stamped it approved. And that is why Enron still matters. The specific company is gone, but its tools never died. Booking optimistic future profits as today's income. Hiding debt in off-balance sheet vehicles. Reporting adjusted earnings that quietly ignore the losses. Every few years, a new company is caught doing a version of exactly what Enron did. Enron wasn't a freak accident. It was a preview of a temptation built into finance itself. So the next time a company is hailed as the most innovative in the world, with profits that seem too smooth and too perfect to be real, remember the footnotes. Remember that the biggest frauds are rarely hidden by geniuses in the shadows. They're the ones everyone can see and no one wants to question. If this file gripped you, this is the Greed Files. True stories of fortunes made, faked, and destroyed. Next time, the German tech giant whose $2 billion simply never existed. Subscribe and keep reading the files with us.